All right, we have spent our time figuring out how the budget works, all of the different ways that the government makes a plan for its taxing and spending, but we need to back up a little bit and figure out where exactly all this money comes from. So today we are going to focus on the federal government's revenue sources. We're going to look at how the government makes money, which really means we're going to take a long look at the taxes that the government levies upon us. So lucky it's objective time. Today, we are going to describe the sources of government revenue, meaning that we're going to look at a bunch of different types of taxes and we're going to see where the government's money comes from. And afterwards, we are going to be able to explain the ideological disagreement on tax policy. So, we're going to take a look at what liberals and conservatives think about how we ought to deal with taxes. So, today, we will answer the question, how does the government make money? All right, so first today we're going to take a look at different types of taxes. So we'll look at different ways that the government raises money from us and corporations and other different economic activity. Here we see our friend Senate Minority Leader Mitch McConnell. This is back in 2017 when he was advocating for President Trump's tax reform policies. So you see some other Republican senators back there. Like you can see a pre-bearded Ted Cruz peeking over McConnell's shoulder there. All right, let's start with revenue. Revenue, this means what is coming in to the government, what money is coming into the federal government. The main source of revenue is taxes. This is a country where we get most of our money from taxing the population. So, since the government is going to get most of its money from taxes, this is why the government is so concerned with promoting economic activity. Economic performance, like when the economy is doing good or badly, has a huge impact on how much taxes the government gets. So the government needs the economy to do well so that it can get more taxes off of the economic activity. When there's a reduction in economic activity, like during a recession or something like that, then that usually reduces the government's revenue. This is definitely this is obvious in the last year or so in dealing with the coronavirus pandemic and the economic collapse that came with it. So, governments, particularly state governments, rely on the performance of their local economies to raise taxes off of like house sales and like sales tax and all sorts of economic activity. If everyone's staying home to stay safe and they're not spending their money, then there's a lot less money for the government to operate with. So, the government needs to do what it can to make sure that the economy is performing well so that they can raise a lot of tax revenue here. So economic booms like boom times should produce like a big increase in the amount of money that the government is able to raise from its populations. The biggest source of revenue for the federal government is the income tax. And income tax in the United States is a progressive tax, which means that the more money you make, the higher the rate you're going to be charged on that money. So we'll talk about that in just a little bit. But for most people, tax is withheld from your paycheck. And you like settle that up at the end of a tax year. For most people who like work for an employer and get paid by that employer, the employer is going to pay them a certain amount, but the government withholds a certain percentage of their check so that they'll have their money to pay taxes. And then when you file your taxes, you may get some of that money back. You may owe some more. Payroll taxes are also collected. And these are charged to both employees and employers. So you can see a little paycheck stub here. I know a lot of you guys are getting paychecks now. You can look on there and you can see your income tax, and that's probably the largest amount of money withheld from your check. You'll see other taxes like Social Security and Medicare, which are a payroll tax, which is a much smaller amount because you're paying some and your company that you work for is paying some. Corporations also pay a tax. They pay taxes on profits, and we'll look at that later about why that is not usually as much money as like what an individual pays. But this is how the government is going to make its money and fund all of the programs and services that it provides to the people. All right, so all of the money that the government makes in a year, some of it goes to specific programs and some of it is spent on like everything in general. and we'll get to that a little later. But first, let's look at where it comes from. And this is so what we see here, we see that about half of all money comes from personal income taxes. So that means that's money coming right out of your pay. Another third, like the 35% there, comes from payroll taxes. And at least half of that comes from people's paychecks as well. So we're really talking about, something like almost two-thirds of all revenue from the government for the government comes right out of people's wages. About a little less than 10% of all government revenue comes from corporate income taxes, and we'll talk about that. And the government makes a small amount of money from other taxes like excise taxes and tariffs and things like that. But the big thing here is that like about two-thirds of all of the money from the federal government comes right out of individual people's paychecks. So when you look at your paycheck, you see that your money is being pulled out in taxes in different ways. And that's because the money goes to different things. So when it's just income tax, that becomes like general federal funds. And that means that the government can spend those and it can choose how it wants to spend those. Your payroll taxes, you'll see one amount pulled out for Social Security and a different amount pulled out for Medicare. These go into specific trust funds. So, like now, all of the people working today have their money come out of their taxes and go into a trust fund for Social Security so that there's a savings account to pay people in the future. And those trust funds only pay for a specific program. So, there's a Social Security trust fund, there's a Medicare trust fund. Over time, the taxes that get saved in the Social Security trust fund, these are supposed to be like spent in the future when Social Security doesn't raise enough money off of taxes to pay all the recipients. We'll end up looking at that program later this week and see if we're probably at that tipping point right now, or in the very near future. So the taxes are planned in a little bit. They're planned to deal with some of the problems in the future for Social Security, at least. This is another important thing for you to understand about taxes. This chart shows us the black line represents the percentage of income that is coming from individual income taxes, and the yellow line is showing the percentage that is coming out of corporate income tax. So you can see that a long time ago, prior to World War II, these were similar numbers, right? The government got similar rates of tax out of people and corporations. But since then, the trend is that the government is getting less and less and less money from corporations. So more and more and more of the government's revenue is coming specifically from individuals and not from businesses. All right, we already said the main source of revenue for the government is the personal income tax. This is a tax that gets charged on the amount of income that you generate in a year. So that can be from wages, it can be from investments, it can be from maybe inheritance in different ways. But any income that you have is going to be taxed by the government. The rates are charged in a progressive way. We'll talk about that a little later, but the rates are charged in tax brackets. And people are able to explain to the government that they didn't necessarily get to use all of that money, or they did some things that the government wanted, and these are called tax deductions. So these are what we call tax expenditures, and you can reduce the amount of income that you have based on your actions over the course of the year. For example, if you pay student loans, you can reduce the amount of income on your taxes. If you donate to charities, if you have expenses for your business and things like that, you're not expected to pay tax on that money. When people file taxes every year, this is a job that individuals have to sit down and they have to figure out how much tax they owe. So the government obviously knows how much income you got from your job, but they may not know about all those expenses that you had. They may not be able to keep track of your student loan interest, or maybe you bought a house or something else. Maybe you gave a lot of money to a charity or something like that. Maybe you have multiple streams of income in different states. And so you have to compile all that work, and that's what we call a tax return. If at the end of the year, the government pulled too much money out of your paycheck, then the government sends you the remaining money back, and that's what we call a tax refund. If you are getting a tax refund, it is exciting because you get a little chunk of money that you weren't counting on. But in general, that's not particularly a good thing. It means that the government has been taking too much money out of your paychecks. And so the government has basically been borrowing money from you for free. So you can see down in the left, we can see a little bit of the percentage that's charged to different amounts of money. So like people that make less than $10,000 a year, they do not pay any taxes. People that are making, so the people whose wages fall below $40,000 a year, they're charged a 12% tax rate on some of that money. People making less than $85,000 a year are charged a 22% tax rate on some of their money. And we'll get into a little more detail about how this goes. But the highest tax rates in the country are 37%. Here we can see the highest tax rates that have been charged in the United States over the last 100 years or so. What you're seeing here is this is called the marginal tax rate. So this is not the tax rate that the people are charged for all of their money, but this is the tax rate that people are charged for like their money over $500,000 a year. So even though, like right now, that number is at 37%, so just below 40%. But back in the 1950s and 60s, which just so happened to be the most prosperous time in the United States economy, and when wages rose for all Americans, you'll see that the tax rates were as high as 90% for the richest Americans. So what that does is that forces companies to stop paying insanely high wages to very, very few people and to find other ways to compensate them. So this was a time when companies started like offering like generous insurance programs and stock options and things like that, other types of benefits to compensate their employees. But now that tax rate has been falling consistently since the 1950s and is still consistently attacked as being too high by particular groups in the Republican Party. And this tends to be like, groups that rely heavily on wealthy donors who would like to pay less taxes. Payroll tax is another type of tax that you pay. This comes out of your income, but it goes into a specific trust fund, and you're going to get these benefits back in the future. Typically, a payroll tax is split down the middle, and half of that money is collected by the worker, and half of that money is collected by the employer. So, like for me, my Social Security tax and my Medicare tax, I pay half, and Shelby County Schools pays half. People that don't work for an employer, like if you work for yourself, if you do like you run your own like very small business like photography or something like that, those people have to pay the full tax themselves. So it's difficult to be like an independent contractor instead of an employee because you end up with a much higher tax burden. You end up with a lot more taxes taken out of your checks. So like I pay 6% Social Security tax, but like if I were an independent contractor, I'd be responsible for paying the full 12.5%. So my taxes are higher because I don't have an employee that matches that rate. All right, corporate taxes. These are taxes that businesses have to pay. Businesses only pay taxes on their profits. And businesses don't pay taxes on money that they invest back into the company. So this is a way of encouraging businesses to invest as much of their profits as possible back into growing their company. This would lead to businesses to grow and grow, which will create more individual taxpayers. It will create more people with jobs and things like that. Also, corporations, if they've made a lot of profits and they end up paying dividends to their stock owners, then those are not profits and those taxes get passed on to the individuals here. So the corporate tax rate is 21%, and that's come down with the most recent tax cuts in 2017 from 35%. So it's already like it's a rate that's being reduced, and businesses don't really pay on a lot of their money. So like if you're a business at the end of the year, you have a lot of profits, you have two choices. You can either pay taxes on those profits and keep the money, or you can like spend all of that profit on making your business better and owe no taxes at all. So this is why you'll see, I'm sure, a lot of memes about how some of our hugest corporations like Amazon, Nike, Coca-Cola, Delta, these companies pay no taxes. Like they do not pay a dollar in corporate taxes because they can give that money back to their stockholders. They can invest that money in growing the company in the future and all of that. So they end up not having to pay taxes to the government. So corporations are going to have a much easier time avoiding paying taxes than individuals are. A lot of wealthy corporations, some of our biggest corporations in the company, don't pay any kind of taxes. At the end of the year, when they see how much money they've made, they can either invest it back into the company or they can do what we call pay a dividend, which means they split it between all of their stockholders. And in that case, individuals that are stockholders end up paying tax on that as income. So the corporation didn't have to pay any tax, but all of the people who made money off of the corporation had to pay tax. The other thing corporations do more and more is they keep their profits overseas. They may register as a company outside of the United States and keep all of their profits there so they don't end up paying United States tax on that. So there's a lot of ways for corporations to avoid paying taxes. And there's not a lot of political interest in making corporations pay anything close to what individuals pay. Another type of tax we have is called an excise tax. An excise tax is a tax on a specific good. So these you don't even notice because they're built into the price of goods. This is like for stuff like alcohol, tobacco, airplane tickets, phone bills. The most common one is gas. So like when you're buying gas for your car, a percentage of what you're paying is a tax. And that tax goes into the Highway Trust Fund, which we talked about way earlier in the year, that helps like maintain the roads and stuff like that. So just as a hypothetical price over there on the left, you'll see like if you're paying like $2.30 a gallon, you can see how much of that cost is split up, and about 20% of that is our gas excise tax. So like 20% of every time you fill up your tank of gas, you're paying an excise tax to the United States government, and then they're using that to fix the roads. All right, and the last type of tax we're going to go through is what we call an estate tax. This is a tax on the right to pass on wealth at your death. You can see a very sad future over there, a tombstone for poor Rakestraw. So when you die and you are passing money on to your family members, especially your children, if your total estate is worth more than $5.5 million, then you have to pay a tax on that. Anyone who is inheriting less than $5 million, anyone who's trying to pass on less than $5 million to their children does not pay a dime of estate tax. But this is a tax that has a lot of critics. Critics call this the death tax because it's a tax you get charged for dying. But this impacts almost no one. This impacts 0.2% of all estates, all people that pass away in this country. But this is a very controversial tax because somehow the 0.2% of families who are passing on millions and millions of dollars to their children have convinced the American population that this is wildly unfair. So this is just a tax on inheritance for people who are inheriting very, very large estates. And this impacts almost no one, but is one of the ways that the government creates money. So like you can't imagine like when very, very wealthy individuals die and they're trying to pass their wealth down to their children, this is a way that the government can generate a lot of revenue. All right, so that's it for types of taxes. We're now going to go through the different tax structures. So we'll start to talk about like what's fair and unfair about different types of ways that taxes are charged to people in the United States.